So whenever you're ready, in in 3, 2, 1, action.
Oh, we just starting YouTube channel.
Take 2. In 3, 2, 1, action.
Good morning, everyone. Welcome back to our coverage of our 2023 banking sector performance, which also covers the macroeconomic You're going to edit it. Okay. Good morning, everyone. Welcome back to Sterling Digest. This is the coverage of our half-year banking sector performance. My name is Ronaldo.
My name is Davis.
And I'm Isabel.
So this in this episode, in the last episode, we covered the performance of the macroeconomic factors, inflation, FX, public debt. In this episode, we're going to cover the specifics, which is the performance of selected banks. So I'll invite maybe a few views from the team here on what caught their eye in terms of banking sector performance in the first half of the year.
Yeah. So a theme that's been recurring is just how NPLs have been doing. Banks are really, or rather, because the economy is experiencing a lot of difficulties, banking NPLs are really going up, and that's reflected in banks' financials. So a lot of banks are ramping up their level of loan loss provisions. That means that they're preempting a lot of losses going forward, or losses on accounts going forward. So that's been a theme. We've also had FX going up quite a bit just because of the dollar shortages that have been there in the market. Some banks, however, have had reductions, such as NCBA as well as Corp Bank. Just showing, so we've had dollar shortages, as was mentioned in our last interaction, but now there are interventions that the CBK has begun making within the interbank FX market, and that's reducing income for banks. But we expect that to be more pronounced from full year 24. Yeah, so I think those are the main themes for me.
Before you move to Isabel, let me take you back to NPLs. A few things stood out in terms of non-performing loans. We saw a high of about 15% in the most recent MPC, that's the Monetary Policy Committee update. So 15% in NPLs, which is a historic high. The average for the first half of the year was about 14.8%, which is significantly higher than the first half of 2022. One bank that stood out in terms of NPLs is KCB. Tell us something about the performance of KCB in terms of asset quality.
Yeah, thank you, Ronaldo. So KCB has really been suffering in terms of their asset quality. And this is primarily, first of all, let's just say, as at half year 2023, their NPLs were at 182 billion Kenya shillings. And that's a significant amount compared to the rest of the banks. And so this is primarily because of their legacy loans. But they sort of mentioned that they've been improving or getting, significant inflows back, or the legacy loans have been paid. However, the 17% NPL ratio is quite high compared to the 15% currently and the 14.8% as at half year 2023. So this is one of the main reasons that the investors are discounting this bank. As at Friday, the price was at around 20, and yet our valuation is around 40. So apart from NPLs, we're also seeing NBK giving this, having an issue and having a loss of 3.8 billion. And so at the end of the day, really, we're not sure whether they'll be able to attain their target NPL this year. We feel like it was a bit optimistic, so probably next year or when interest rates start coming down. But they speak of them doing write-offs just to clean the book. So we've not confirmed it, but that's one of the strategies that we foresee that would help them, restart afresh. That means the profit will be hit in a specific quarter, and then after that, now they start doing better decisions in terms of who they give access to their loans. Like their asset quality is quite low right now. Also, that's why you will see them having huge holdings in their government securities just to hedge against that deteriorating asset quality. And we'll continue to see that for the full year 2023.
So in terms of magnitude, the 182 billion is close to 30% of banking sector NPLs, which is extremely high. Let's go to FX. Here we're talking about non-funded income. In the first, I would say last year we saw significant growth in NFI, particularly in foreign exchange trading income. This quarter or the first half of the year, I've seen a decline in the pace of growth. Okay, the growth is positive, but the pace of growth has declined. What are our expectations for the rest of the year?
So for the rest of the year, we'd expect that FX income will still remain elevated. So volumes are quite high, even though margins for banks are thinning. As was mentioned, the CBK started a few interventions, such as allowing regional and foreign banks to trade within the interbank FX market to boost liquidity, as well as introducing a two-way system such that banks can trade between one another. Before it was OTC, so it was just more of negotiations between banks. Now at least there's a two-way system or a two-way quoting system. So with those interventions by the CBK, ideally you should see the FX income start coming down and subsequently NFI, because the margins before were making margins of 10 and 12 shillings, whereas now those are coming down to 5-6 shillings, and they'll revert to what they were before historically in due course, more so full year 24. Full year 23, they'll continue doing well, save for NCBA as well as Corp Bank, who are already feeling the effects of those interventions by the CBK. Like if you consider NCBA, for example, the FX income last year had grown by almost between 3 and 4 times what was the year before. So it was very unsustainable. And then the NFI contribution to total income was almost 50%. So that's why they're really feeling the effects of this. It will hit the operating income and other income lines. Yeah. So this year, I wouldn't say all banks will be affected. Mostly those two banks which are outliers. Next year, all banks across the board will have material effects on that income line.
Thank you for that. We've talked about NFI growth. We also saw a strong growth in interest income. A few banks stood out. Equity Bank, KSB itself. Tell us more about interest income growth.
Yeah. So for our covered banks, interest income was primarily due to the spike in interest rates and also the implementation of the risk-based pricing models. And yes, as Ronaldo has said, for equity and KCB, TMB and BCDC really contributed a lot to first the book value or the total assets of these companies, and in turn then the interest income. So when we're talking about the implementation of the risk-based pricing model, it's not just the new loans that are being repriced. It's also the old book, but for specific counters. So that's really given banks the motivation to go aggressive on their lending. However, for banks like Stanbic, we noticed that last year they had been growing their loan book by 27 to 34%, but now they're growing it by like 11-13% just to tame the aggressive lending, because even if interest rates are going up and you want to leverage on the margins, you don't want it to be at the cost of asset quality. So that's a balance that the banks are striving to have for this year, first half of the year and the rest of the year. Also, when we're talking about interest rates, you've seen a competition between total interest income and interest expense. So So that's another issue that's been done. We expect it to continue full year 23. So that means that NIMs will be shrinking for some of the banks. One of it is KCB Bank. NIMs was 7%, around 7%, declined to 6% because of this competition. Also talking about interest rates, cost of funds will also be high full year 2023. The same bank, KCB, cost of funds increased to 3.5 from 3%. And so in terms of interest income, really yes, margins are high, but for some banks they are prudent enough not to lose on asset quality, but also they are looking at how to decrease their interest expense. And one of the ways would be to focus more on current account, savings accounts, which are more affordable deposits, so that you reduce your cost of funds. But at the end of the day, interest rates are so high, it would be sort of impossible to decrease this. We expect this to continue for year 23.
Okay, thank you. Just for clarity, NIMS, which is the net interest margin, is the difference between interest income and interest expense.
Yes.
Something else that stood out from the banking sector performance in the first half of the year was price performance. We saw a growth of 62% in the price of NCBA, while on the flip side we saw a significant decline in the price of KCB. So what would you attribute the price increase, NCBA's price increase to?
Well, I'd say that due to the material growth in their income lines, just considering how much they've grown last year, when you look at the profits, the dividends that they gave out, it became a very attractive stock. So if you'd happen to buy the stock at the range, it had traded between 23 and 25 for almost a year or so. So that means that a lot of people have been accumulating at that particular level, and then there was that dividend announcement, which means that your yield would have been almost at 20%, if not above 20%. So those factors, just the fact that their income grew significantly, profits grew significantly, and then the dividend announcement meant that investors were really interested in this stock. The stock rallied quite a bit, remains quite up there in terms of performance. Yeah, and it's likely to, in my opinion, maybe stagnate at that level because of just the competition from other asset prices. Because you have bonds right now giving you rates of 18%. We saw that on the 5-year bond. That means that the opportunity cost of investing in stocks is high. So at least for NCB, I'd expect the stock price to remain flat for a while and possibly even come down, depending on the nature of the, let's say, bonds that the CPK issues. So for example, if they do IFBs, infrastructure bonds, because these are tax-free, and then you could be getting rates of 17-18% possibly. That would even incentivize some people to sell off some holdings of stocks and just buy bonds. Yeah, so that's what led to the growth, and those are expectations going forward.